The International Accounting Standards Board has published a discussion paper that we're seeking comment on. It addresses the accounting for issuers of financial instruments and how they should classify those financial instruments as either debt or equity. It also addresses the disclosure and presentation of those financial instruments. A particular area of focus in the discussion paper is the accounting for more complex instruments, instruments that include features of both ordinary shares and bonds. A common example of that type of instrument is a convertible bond, so a financial instrument that starts its life as a bond and may convert into ordinary shares. There are a growing number of more complex financial instruments as a result of financial innovation. At the moment, when companies account for their financial instruments, they apply our standard IAS 32. In general, IAS 32 has worked well. However, there are challenges with the accounting for some complex instruments. Companies are unsure about how to apply IAS 32 to them. One of the main reasons for this is that the basis for the classification as either liabilities or equity isn't particularly clear. Also, we don't have many specific requirements for the accounting for some more recent instruments, for the simple reason that IAS 32 was written more than 20 years ago. Because of this, we have some diversity in the application of the accounting for financial instruments today. This diversity means in turn that it's difficult for investors to assess the effects of financial instruments and to make comparisons between companies, because it can be difficult to understand the effect on the financial position and financial performance of the issuers of financial instruments. In addition, investors have not been satisfied with the amount of information provided about financial instruments in financial statements, particularly in the case of equity instruments. And that's because the disclosure requirements in this area at the moment are quite limited. This distinction between liabilities and equity is important. Whether a financial instrument is classified as one or the other can have a big effect on how profitable a company looks and how solid its financial position looks in the financial statements. The IASB would like to address these issues. We've developed a classification approach building on a simple idea, namely that companies ask themselves two questions about a financial instrument. Firstly, can I be required to hand over cash or another financial asset? Secondly, have I promised the instrument's holder a return regardless of my own financial performance or the performance of my share price? If the answer to one or both of those questions is yes, the company's issued a liability. If the answer to both of those questions is no, then you've issued an equity instrument. The discussion paper explores how to apply this simple idea to a variety of financial instruments, particularly complex ones. However, the board also recognises that a binary classification between liabilities and equity can only ever tell part of the story. So in addition, the discussion paper includes proposals for presentation and disclosure to help companies tell the full story. We think that the approach in the discussion paper makes the principles for distinguishing financial liabilities from equity clearer, and also that it improves presentation and disclosure. This should result in two things. Firstly, it will help companies who are accounting for financial instruments. And secondly, it will give investors richer and more comparable information about them. Clearer principles should also make it easier to apply the approach to new financial instruments as they continue to evolve. But having said that, we've taken care not to change the parts of IAS 32 that we know work well in practice. So the classification for simple bonds, ordinary shares, and many other financial instruments would not be changed as a result of this approach. We're now asking stakeholders to comment on the discussion paper to help us work out the way forward. We welcome your comments by the end of this year.